Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined by Shaun Richards from Not a Yes Man Economics, and we're going to look at Mark Carney. Well, it's the end of 2017. Let's give him an end of term or end of year report. You are marking his homework. How do you think he's performed, and if he's underperformed, what can he do to improve for 2018, Shaun?
Okay, well, I think one bit of it he did yesterday, which was the spin round on the View and pointing out that the UK is a big banking sector and will probably be Europe's banking sector, whatever unfolds over the next year, 2, 3 years in terms of the Brexit issue.
I mean, I personally think he deserves a gold star for that. He kind of stood above politicians, and actually, I thought he handled that quite well.
I think there have been two events, actually, if we pin back and say that you give him credit for. One was most of the speech the day after the vote, and then the next one would be yesterday. Going back to June 2016, what would that have been? June 24th, I think. The reason I like that was it's a proper central banking role to stand up in a time of crisis and say, we're here and we're ready, which he did. He announced various things that were never actually used, but in a way that was the point of it. You know, and it's the same thing in a banking crisis. There's supposed to be. Sadly, that didn't work with Northern Rock, but that wasn't on Carney's shift. They stand there, the money's here, we're ready, lads. And that was, of course, at a time particularly where the Prime Minister having resigned and things like that, there wasn't really anyone else around. Back to yesterday, refreshing in the fact that apart from that, most of his sort of views on these things have been always downbeat, depressing, the world's going to end, chicken licking style sort of thing. So that's good. If we move, though, to his main gig, there's quite a list of problems if we come to monetary policy. We start with the consequences of the Ely vote when the Bank of England cut rates and did all that QE. To what end? In my opinion, it made things worse by pushing the pound lower than it otherwise had gone. Now, don't misunderstand me. I think the pound would have fallen anyway. It already had. But him standing up the next day, in essence, saying we're going to cut bank rate, we're going to do loads, and other Bank of England members coming in, chiming in with that, meant, I think, that we went into the low 120s against the US dollar, for example, whereas maybe it would have been the high 120s and 130. Why does that matter? It pushed inflation higher, which has been the player this year, has been the bad news, is real wages being lower. That's what's hit the economy. Why have they been lower? Because inflation's higher. And it's supposed to be the Bank of England's job to keep on top of inflation, not pump it up. And of course, we saw last month the fact that they reversed the move. They never actually said that it was because they'd made a mistake. They had all sorts of other reasons, but that was the rationale in it. So the checklist on monetary policy is a lot more difficult. And especially, and this is only partly his shift because he came in 2013, but especially in effect, take out the up and down we just seen, we're still at what was considered an emergency bank rate when it was brought in. What was it? I think 2009, 2010, all the cuts took place. So there's a lot of issues here. 2009, excuse me, sorry. And so there's that fundamental issue. 8, 9 years later, we're still at that, and yet we're told things have got better.
So looking forward to 2018, how excuse me, how can Mark Carney do better?
I think a serious approach looking forward to actually controlling inflation. We've moved into a new era now, I think, which is that wage growth seems to be stuck and is 2% or a little bit over 2%. Therefore, it's become even more important to control inflation. Just even a small amount over, which in the grand scheme of things, the UK's seen this year, compared to the past, 3% on one measure, 4% on another, is a low rate. But if wages only stay at 2%, that's a big deal because it puts a squeeze on people. So, in my opinion, it's even more important to be really on top of inflation and make sure you keep it down. And so there's something going forward he could improve in. I think also the secondary issue is he has brought in on his watch quite a few policies, or carried on with, in the case of the funding for lending scheme, now with the term funding scheme, things that encourage the housing market. Something else, in my opinion, that can't go on forever. House prices keep pushing them up. because in so many places they're unaffordable. It depends where you live. In parts of the UK, different impacts, but in general, across the southeast and a much larger swathe, southwest, moving up through the Midlands, places are unaffordable now. And so there's another area where I think that the Bank of England has played the game. There was even a thing on the Bank Underground blog recently. It in essence says house prices have trebled over a certain period and then says it pushes the economy higher. That's the way they measure it. The other side of it is people find houses unaffordable. You'll find it hard to get first-time buyers telling you they're better off. So there's the other side of the coin. A change of course. There's two clear things he could do.
Well, take note, Mr. Carney. But in the meantime, Shaun Richards, thank you very much for joining us throughout 2017.
Thank you.
Look forward to having you back in 2018.